Hi, this is Mike Maloney, and I just wanted to do a quick market update because there are some really big things happening in the global markets. Now, about 5 weeks ago, we put up a video about what would happen if somebody asked me at the Silver Summit back last November, what will happen if Janet Yellen raises interest rates. And I basically said that the crash will come sooner rather than later. And she did raise interest rates, even though, as you will see in the upcoming charts, the rate rise was absolutely insignificant, yet the perception by the markets I mean, it's looks like it's going to be devastating. My insiders and people that were subscribed to my Wealth Cycles service have seen this chart many times. I've been referring to this chart for more than a year and a half, maybe 2 years. But this goes back into the mid 50s, the early 50s. And the blue line here is interest rates. It's the effective Fed funds rate. And you see it peak in 1980 and then it pulls back. But the reason I show it is just to show that we're still in this extreme emergency, that interest rates have never been zero like this before, especially for this long. They've been close to zero back during the Great Depression, but nothing like this. And then this brick red line, this is the Wilshire 5000 Total Market Cap Index. So it's basically a measurement of the value of the stock market, the 5,000 largest companies in America. And then the green line here is base currency, the monetary base. The Federal Reserve incorrectly refers to it as base money. It's currency, not money, and people should start defining the difference between them. Money has to be a store of value, currency does not. But what you see here is an incredible correlation. And there's also these gray bars. These are recession bars. And the reason I've left them on here is just to keep on reminding people that recessions happen every 2 to 9 years. There's a recession. And the periods of economic expansion between them, we're already in a period that has gone on 7 years. The longest ones are 9 years. So the longer we go here, the greater and greater the likelihood that there is a recession around the corner. Now, recessions, when you hear that we're in a recession, it's a trailing indicator. They have to measure the previous quarter's growth in GDP. If our economy grew, we didn't have a recession. If it shrank, we did. If there's 2 consecutive quarters where the economy contracts, that's considered a recession. So you don't find out when they announce that we're in a recession, it means that we've been in a recession for more than 6 months. I believe that the recession has already begun. Now I'm zooming up on the exact same chart. I'm zooming up on the area that's this century, so just this area. And just to show you this incredible correlation, here is the base currency. And this is the stock market again. And here is interest rates. And you can see this little blip on the end that's so insignificant. That's that quarter point rate hike. It's silly that is having an effect on the markets, but it is. Now I'm going to zoom up again from the crisis of '08 to today. And what you see here is the creation of base currency and this incredible correlation to the stock market that is this only being just a coincidence is an impossibility. The creation of base currency absolutely is responsible for the levitation of the stock markets. There's no possible chance that this is coincidence. This correlation is just too tight. But what I noticed here is that they took off the training wheels when they tapered in 2014, and the stock market kept on going, but then it crashed right back down to base currency, and then it got levitated again, and it's crashing again. But in making this chart just a little while ago, I noticed this that base currency is suddenly shrinking. And I'm going to zoom up now to just this top so that you can see the divergence here and what's going on. And I find this very interesting. We ended QE. The markets kept on going without the training wheels, and then it crashed, and it exactly matched base currency again for a little while, and then it levitated again. Now it's crashing, but look at where base currency is. Base currency is diving, so this crash that we're in now could have a lot further to go. But when I look at this chart, I also notice something else, that there is in the stock market, the red line, there's a shoulder, a head, and a shoulder that has developed. And there's a neckline, and we are piercing the neckline right now. When I do charts of the Dow Jones Industrial Average on this close-up, you can clearly see this head and shoulders pattern that has developed and a neckline. Here is the Wilshire 5000, much broader measurement of the market, and again, very, very clear head and shoulders pattern that has developed, and here we've already broken the neckline. This is a chart, equal weighted US stock index, and this is from Zero Hedge, I believe. But here you see an even more pronounced head and shoulders pattern and a neckline that has already broken. Now, for people that don't know what a head and shoulders pattern is, a stock rises and then loses steam and starts to fall and then bounces and it exceeds its previous high. But it loses steam again and falls, and that's a sign of weakness. And then if it starts to rally again but can't exceed its previous high, that's like confirmation that this stock is weak and it's going down. And when it falls, you take these two previous times that it fell, you draw a line across those, that's called the neckline. When it breaks that neckline, the predicted move is that if you took the neckline like a hinge and flipped the head upside down, that's the area that we're going to. So this is equally weighted US stock index. This is a global stock market cap index. This again is from Zero Hedge. But you clearly see this head and shoulders pattern again on this global stock index. So this is a worldwide event that we are in for. Head and shoulders patterns are one of the most reliable. It doesn't prove out every time, but probably 60% of the time that you see a head and shoulders pattern, it will end up proving itself out. And here I take a 20-year view of the Dow Jones Industrial Average, and you see that head and shoulders pattern. And the reason I'm taking this 20-year view of the head of the Dow, and this is the Wilshire 5000, is because I wanted to show that we have a long, long way to fall, potentially, in this crash. Investors have been very nervous, and they pay attention a lot more, and a lot of people believe that they can ride the stock market and all get out before the next crash. So they're just sitting on that exit button, just waiting to get out. And lastly, I want to show you a chart of gold over the same time period. It's been a much more stable, better investment than stocks over this same time period. So I think that we are in for something very dramatic. I think that 2016 is going to go down as a record year. We will probably be seeing a bounce in the stock market sometime soon, but I do believe that the top is in and that stocks are not the place to be anymore. I think gold could go down a little bit more. If it breaks 1,000, spreads are going to go huge, and you won't be able to buy physical. Physical won't go down. It will diverge from the spot price of the commodities exchange contracts, the futures that determine gold's price. So the futures contracts price may go down, but physical won't. And so that is my update. I think that this is the year that stocks roll over. The last couple of crashes, it took 2.5 years here, took about a year and a half in the '08 crash. And I think this one could be even faster. I think people are, investors that have been burned twice now this century, are very nervous. And all the people, the baby boomers that have their savings tied up in the market, their retirement, they want to try and protect that. So as this starts to go down, I think you're going to see more and more people exit stocks much more quickly than they did last time. So that's my view on where we're going in 2016. Thanks for listening. We'll see you next time.